Hello everyone, this is Professor Kent. Today's recording is Chapter 9 Investment Part 2. Again, I lost a couple parts before. It was deleted by accident. So I'm re-recording Chapter 9. Some of you guys asked for it. So I left off the first one and at 9.8 and now I am starting with 9.9. So what we're doing is we're doing a fair value net income model, but it's an investment. And the last one in this case it's investment in non-bearing interest, so non-interest bearing instruments. It's a non-interest bearing note. That's what it is. And asking you to prepare a journal entry. How would you know it's a treasury? Of course, by looking at it, they know that it's a 6 months treasury bill. If it's a 6 months treasury bill you're investing it, it is an investment accounted for as a treasury bill. So when you do that, what we needed to do is we needed to calculate the present value. If it's not calculated, if it's not given, you have to calculate the fair value at the time of the investment, which is equal to your present value. They told us in the question is 19,231. And what happens in this case, we will have to the face value of your bond with the face value of your bond of your treasury bill is 20,000. So again, if it's called like a similar to non-interest bearing note that you learned in your previous accounting courses. So when you're doing our first entry will be at the fair value, that will be my March 15th. March 15, we investor, my debit will be fair value net income investment, and it will be 9231 we paid cash. For 6 months from now, what we needed to do is, if this is 19,231, 6 months from now you want the value to be 20,000. So in between we might have to record our investment. They told you that this investment is designated at a 90 at a fair value net income investment. So what happens is, let's say that it prepare the journal entry. So the bill will mature on 15th. So this is on March 15th and is on September 15th. 6 months are gone by, and now what we needed to do is we're going to receive cash. The cash we're going to receive is 20,000 from them, and what we have is we have our the value of your investment. This is my fair value net income investment, and I needed to make this zero. How would I make it zero? By crediting it. So let's credit the fair value net income investment of 19,231. Now we kind of, another way of looking at that, we sold it. Now what we have is difference between those two is my gain slash loss on disposal. And what are you disposing? An investment. In this case it's an investment. What type of investment? Is fair value net income investment, and that will be the entry. So we have done a lot of them with entries with the fair value. Now what we have is we have a fair value net income investment in portfolio. What is a portfolio? When you invest into different markets, a portfolio have different companies. Some you purchase shares, some you purchase bonds, some you purchase something else. So portfolio has both debt investments and an equity investment, so it has both. And what they're doing is they're just, in this case, if you have a bond, you are going to be receiving interest from them. If you have shares, you will be if you have shares, you will be receiving dividend from them. But if you record your investment in investment under fair value, you also have to do an adjusting entry at the end. In this case, they're just looking for the adjusting entry at the end. That's all they're looking for. So what we needed to do is the values in your books is sitting as 314,450. The value that you need is 38138 200. First we needed to find out the difference between those two is 3750. Now if I were to look at it, if you wanted to do that, you could put it fair value net income investment. I always like to do T counts to see it. The value of your investment is 314 450. I need a value of 38200, so I needed to increase it. How much am I increasing it? If I'm increasing it, I needed to debit 3750, and then I will have a fair value net income investment will be a debit of 3750, and we have an investment income slash loss. Income slash loss will be your 3750. So you continue doing what you need to do for each one. So this is will be what will this will be called? This will be called my adjusting entry. So now when you have this entry, this portfolio changes. So this is where we're gonna go with your portfolio changes. So what we're doing is we're going back to 910. What they said is now you could be buying something, you could be selling something. So in this case, we have each investment, you have to keep it separately, because in the portfolio we have the first portfolio was this portfolio is after the adjusting entry. This is your first in this case I'm just going to put it like this so that I can show you next. This is Burlington shares, because what you're going to do is whatever you started off with, what it is, you could do an individual ones too, but I'm just going to show you what the ending entry is so that it can make your life easier. So that is 91,500. If I add three numbers, then what we are going to do is I will get a number of that's the value at the end of my adjusting entry. So now what we're doing is we're not selling everything, we're only selling part of it. We wanted to know what happens at that point. They said that we're purchasing something and we could sell something in the portfolio. Assume that Canesta Corporation bonds are sold for 174 on February 14. So next what we needed to do, and we need to do an entry for February 14 or February 4 2004, and it is my investment, that is this investment, GENESTA, and this is my Warner. So what we're doing is we're selling this. If you're selling it, means we needed to make it zero. How would you make it zero? By crediting that. So what we have to do is we have a fair value net income investment. We have to get rid of what the value was, 175,200, and then what we're going to do is how much did we sold it for? They told us in the question we sold it for 174. So we sold it for less than what it is worth, 74,000, and if it's a less, we will have a loss. In this case, we have a loss on a disposal, and that is fair value net income investment. Difference between those two is 1,200, and at the same time they purchase once. If they purchase it, we have to do fair value net income investment, and the value of that will be 49,900, and then we have to do a credit cash of 49,900. If I were to do that now, I already sold this investment. What are we left with? We left with only three investment again, 51500, then we have 91,500, and we have your third investment that we just got on February 4th, and then going further they're telling you. So this is, if I were to do that, this is exactly what I showed you on the screen. Now what they want you to do is record the journal entry at the end to do the investment. So again, it could go up or it could go down, it could increase or a decrease. If it's a fair value, you need to record the value at the fair value. If it's recording at a fair value, you need to do an adjustment at the end. What will be your adjustment? Either goes up or down. If it goes up, I will have to debit the investment income, go down, sorry, investment income slash loss, and the credit will be your fair value net income investment. For the amount will be 1790. So you keep doing what you're doing, and what we do is we keep a running total of it when you do it. And anytime any investment is recorded at a fair value, you have to do one adjusting entry at the end in order to do that adjust, in order to put them to the fair value. Now my next one is your fair value OCI model. When you have a fair value OCI model, first one is that only IFRS company is allowed to do this, because if it's a ASPE company, they don't have fair value other comprehensive income. They don't have those investments. First of all, that's the difference. Only IFRS company will have it. It is similar to what we did, but now in this case you have an investment into shares. If you have an investment into shares, what are you going to get? You're going to get a dividend income. So we're going to show you how to record in the fair value OCI model, which is used by IFRS. What they did is they purchased these shares. So this is the acquisition price. So we bought lot of shares from different companies. So first what we need to do is, when did we purchase it? We purchased it on November 3rd. They asked you to record all the purchases. November 1st, 3rd, 2022. What we have is we invested. The management tell you what they want, how they want to record this investment under it. They want to do it under OCI. So if it's OCI, I will purchase it at a fair value. I will give them a cash of 718,550. They told us on December 31st. What they did is we received a dividend. So if you received a dividend, debit will be a cash of 14,200. Credit will be your dividend in revenue. Some companies also call it dividend income. That is also good. So I can spell revenue, ENNUE. 42,200. So this will be my first entry. This entry will be on December 6th. So now, since it's an investment, what we needed to do is we needed to December 6th, 2020, and then what we needed to do is we needed to do an adjusting entry on December 31st, 23 to a fair value. So when you do that, each investment, either you have a gain, but what we need to do is we need to do a one entry in here, because everything is invested in the portfolio. When you have it, we call it under the OCI, we call it, it's an unrealized, we have an unrealized gain and a loss. Again, the value of your OCI investment is that the value that we need is 683. How do we know that? The question will tell you. So it's, sorry, it's at 22, not 23. How do we know? The question will tell you, if I were have an investment of 78550, and then I need a balance of 683. Difference between those two, either I need a debit or a credit. In this case is 35,550, and that is the value of your fair value OCI investment on that. What I have to do is I need to credit that account, and debit will be my unrealized gain and loss. Now in this case, I'm going to leave it there because I'm going to show you one more step. Unrealized gain and loss. In this case, we have a fair value OCI investment went down by 35,500, 35,500. So investment. Now the part here you needed to remember is, since it's you seen it on the income statement, we have a net income. So when you have a net income, as we with the other the unrealized gain will sit after the net income, and that gets closed to accumulated other comprehensive income. So we know that everything on the income statement gets closed. So we have a net income, and then we have an unrealized gain and a loss on fair value OCI investment, or anything else other than it could be foreign investments or foreign exchange. They call them, the other one is other, your next your other comprehensive income. Under that you have unrealized, you could have an unrealized gain and loss. Since we say that everything on the income statement gets close to accumulated other comprehensive income, you needed to do a running total of it. So if you have a debit balance, or your other cumulative comprehensive income will start off with, will at the end will have a credit balance. Because if you sorry how do we, so another way to look at it, how do we close that? If this is a debit, in order loss, if this is a debit, how would you do it? You will credit that account. We call it unrealized gain slash loss, and debit will be other cumulative other comprehensive income for 35,500. You don't need to show this entry, but just remember that entry, that we have a debit balance in our other comprehensive income, accumulated other comprehensive income. So let's go further. When you sell the investment in when we're selling the investment, what do we do with it? So when you, the way I always say that each if you look at it, each of your investment has its own gain and loss. Some has gain, some have a loss, and then they get close to accumulate other comprehensive income. Now they're saying now we're talking about a new, now assume that Manitoba sells all its Nova Industries limited common share on January 31st, and receiving a proceed of 287,200. So that's what they said. So what we needed, if you look at it, you can also do this. This is Nova, we have a Columbia, you have a Saint Boniface. The value is whatever is the value we recorded it, so that is sitting as 275 here, 304 here, and we have 104 here. When you think of it, now we also have an unrealized gain and loss. Some has debit, some has credit. So if it's a gain, it's a positive number. If it's a loss, it's a negative number. If you have a gain, if we think of it, if we had a gain is a credit balance, and if it's a loss, it will be a debit balance. So when you close it, what you close it to, that's what the part you needed to remember here. But let's show you and see what happens when you have a fair value OCI model. First we needed to bring it to that value that you're selling, then close it. So it's two when you do the entry, what we have to do is first we needed to bring it up to that value. What we're doing is we're selling it for 287,220. First we have to bring it up to that value. When you bring it up to the value, you needed to debit it. So how much are you debiting? The difference between those two accounts, those two numbers, is 12,220. So let's do the first entry. When you sell it, bring it up to the value, then sell it, and then you have to clear your other comprehensive income. So there's two entries when you have when you have a investment in fair value OCI. So first what we're going to do is fair value OCI investment. What happened is 12,200, 220, and then what we have is unrealized gain and loss on OCI, unrealized gain slash loss on OCI. So this is the first entry, is to bring it up to the value that we're selling. Second is we sell it. When you sell it, you have a debit of 287,220. Credit will be fair value OCI investment for 287,220. Third one is to clear your other comprehensive income. So when you clear your other comprehensive income, if I were to do is think of it, what will be the value of your other accumulated other comprehensive just for the Nova. When you think of it, when we did our first entry, we had a credit balance. So what we had is we had a gain. And how would you do a debit? You if you had if this one was gain, you have a gain, you already have a credit. How would you make it zero? By debiting that. So when you debit that, I have a value of 53,200 15,300. That's the value was sitting there. If now we have an unrealized gain with the Nova again, and how will we close that? We close this we'll debit this account and we credit the 12,200. So that's the entry. So what we have to do is now when you sell it, you have to make your other comprehensive income to a zero. How do we make it zero? By debiting accumulative other comprehensive income for the both amount, which is 27,520. 27,520 credit will be your retained earning. So in other words, this is called, we call this a realized profit. This is called a realized profit. Let's go further and see what else we have, so we could kind of I think I'm gonna do this one. This is similar to what we did. They just want you to record the value to fair value model, and when you have an investment into shares, it's a similar. The only difference here is that you have to record the adjusting entry at the end, but some of the questions are exactly the same as what we did. The only thing you needed to worry about it, remembering to put it into your balance in the accumulated other comprehensive income. Now this one was the cost, this is the carrying value, this is the fair value. So what we needed to do is we need to record our investment at a fair value, and we needed to do an adjusting. Some will be a gains and some will be a losses. In this case, the value of your portfolio is 408, the value we need is 501, and then I'm keep repeating this. So we have to increase it. How much we increase OCI investment, and that will be 93,600, and credit will be your unrealized gains. You could have a one equity, or you could have more than one, but the entry does not change. Unrealized gain and loss on OCI investments, that is 93,600. Again, you could have a fair value OCI investment in bonds too. And then what we're going to do is we're going to show you it's similar to what we did. Again, this transaction is similar to fair value net income investment. The only difference is before we closed it closed it out to investment slash income, and now what we are doing is the only difference is now we are recording an unrealized gain and loss and on an investment when we have a bond investment, or when we have any fair value OCI investment. So they said to go back, and I'm going to just do this do this question. So they said go back, and we sold the bond for 108. If we are recording this bond as a fair value OCI investment, we will debit the OCI investment and at the 10811, and we paid cash 108,111, and then we needed to record the first payment. If you remember, we did have a cash. When you have a OCI, it's similar to what we did under ASPE with the amortization, but when you did fair value net income, there's no amortization part of it. Cash will be 5,000, and my fair value OCI investment, that's my amortization part, which 676, and we have an interest income of 4324. So the part you needed to, whatever you did under fair value net income investment under the ASPE, these transactions are exactly the same, because the question we did was that they use an effective method. That's what the IFRS will be doing. So all your journal entries are similar. If you wanted to just kind of remember it in your mind. So this is my first entry, this is my second entry. When we have a July 1st first payment of the month, we have a year end. My year ended December 31st. I will have an interest receivable of 5,000 because we're not receiving it till the end of next year. Fair value OCI investment is for the amortization part of it, which is 703, and we have an interest income. Now you amortize the way you've been doing it. The only difference is you're gonna have another you're going to have keep a running total of your fair value OCI investment for the year end entry. So we started with 108,111. We did an entry for 676. We did an entry for 703. And what now we needed to know, the value we need is 106,732. And what we going to do is we are going to see what the number was. And I think so the number we need was 105, sorry. So this is it comes out to be 106,732. The value we need at the end of December 31st, the value we need is 105. We will be doing an adjusting entry for 1732 if I'm doing an adjusting entry to a credit. So this will be your entry, a credit. This will be my December 31st to bring it to the fair value, or we call it revalue the bond. In this case, I will have to debit unrealized gain / loss of 1732. Credit will be for my fair value OCI investment. Similar to what we did, if it's saying recycling, you have to clear that account, bring it up to that value, and then you have to close it. They did not ask me to do that in this question. I am going to do the questions at the back in order to the exercise at the back. I think I already have a video, so if you want to follow them, you could watch that video. But I wanted to I can always finish it off to bring it to, it's just only one left. I don't want to keep doing the same questions over and over again. I just wanted to give you an overview of when you have a fair value OCI model. The best way to remember is whatever we did under fair value net income investment under ASPE, and if they were using an effective method, your transactions are exactly the same. The only difference is that you have to do an adjusting entry at the end. It is unrealized gain and loss instead of investment income / loss. So I'm going to finish the recording here. If you have any question, don't forget to message me underneath the video so I can record something. If there's anything else you want me to record, please let me know, but give me some time to record it when sometimes it gets really busy within the schedule when I'm teaching. Thank you so much for subscribing. Take care and bye for now.